Silver has gone from something people thought belonged in an old drawer to one of the most important industrial commodities on the planet, and almost nobody seems to understand what that means. That is what interests me, because whenever something moves from being ignored to being strategically important, and the public still treats it like a curiosity, I start paying very close attention. Most people are busy staring at technology stocks, interest rates, elections, wars, whatever. The loudest thing on television happens to be that week, fine. Let them. But while people were looking elsewhere, a very quiet rule change was pushed through in the background. That changes how silver and stocks interact in a profound way. Wall Street is not eager to put that story on the evening news. I can understand why. Quiet rule changes are where very large fortunes are often protected or made, and where a great many ordinary investors get hurt simply because they never knew the rule book had changed underneath them. Now, I want to be clear about something. This is not really a silver story. Silver is the vehicle. The deeper story is about regulation, market plumbing, industrial scarcity, and a single ratio that has flashed the same signal only a handful of times in the last half-century. And every time that ratio reached an extreme, the move that followed was painful for people who were asleep in life, changing for people who were paying attention. So let me begin where I think the truth usually lives. Not in price, in ratio. Price alone can mislead you because price moves for too many reasons. Inflation, the dollar emotion, television, speculation, noise. But a ratio tells you one thing relative to another thing, stripped of some of the nonsense. The ratio I care about here is silver divided by the S&P 500. That is all silver compared to the American stock market. If the ratio is high, silver is expensive relative to stocks. If the ratio is low, silver is cheap relative to stocks. Very simple. And simplicity matters because markets often get explained in ways that are much more complicated than they need to be. Now, if you study that ratio over the last 50 years, something extraordinary appears. Every time the ratio got crushed down to an extreme low, silver eventually ripped higher relative to stocks. Not once, repeatedly. In the great silver blow-off of the early 1980s, silver went vertical relative to the stock market. In 2011, silver again surged hard relative to the S&P 500. And in between, there were a series of moments when silver became absurdly cheap relative to stocks. And those moments were later followed by powerful multi-year rallies. That is what matters to me. Not because history repeats cleanly, it does not. But because when a relationship shows the same kind of tension again and again over long periods, I stop treating it like coincidence. I start treating it like structure. And right now, silver relative to the stock market is sitting down near one of the lowest readings of the modern era. That is not a dramatic opinion. That is just the chart. Silver is historically cheap compared with stocks. Now, that fact alone would already interest me, because whenever one asset gets extremely cheap relative to another, I want to know whether the market is correctly discounting reality or simply carrying an outdated assumption forward because nobody has forced it to think harder yet. But the chart is only the beginning. What makes this setup more serious is that the market structure beneath silver has changed. Quietly, not with trumpets, not with some prime-time announcement, with regulation. And regulation is one of those things most people ignore until it starts moving their money. The rule change I am talking about is Basel III, and more specifically, the net stable funding ratio attached to unallocated precious metals. That phrase is enough to make ordinary people stop listening, which is probably why so much of Wall Street loves speaking that way. Complicated language hides simple incentives. So let me translate it. For years, banks could hold vast amounts of what is essentially paper silver promises, claims unallocated exposure, silver that existed more as an accounting relationship than as a specific bar sitting in a vault with someone's name on it. And because that paper structure was cheap and profitable for the banking system, it allowed the market to function with a great deal more paper silver floating around than real physical silver. That matters because paper supply has a way of leaning on price. If you can create enough paper exposure, you can create the appearance of abundance more easily than the real world would justify. Now, Basel III changes the economics of that game under the newer rules. If a bank wants to hold unallocated silver, it must fund that position much more heavily. In practical terms, the position becomes expensive. What used to be a nice little profit center becomes much less attractive. It starts looking more like a cost center. And once the economics of a business line worsen, behavior changes. That is one of the most reliable truths in finance. Banks do not cling to old structures because of nostalgia. They cling to them because they are profitable. Once the profitability is damaged, they reduce exposure, retreat, or change how they participate. That is exactly why this matters. A market that for years could be saturated with paper silver now has more pressure pushing it toward real, allocated physical silver instead. That changes the floor, not the ceiling, the floor. And floors matter because most people only focus on the explosive upside scenario while ignoring the fact that one of the biggest questions in any market is whether the downside is being quietly restricted by structural change. If a bank must now think much harder before carrying paper silver exposure, then some of the old pressure on the market weakens, not all at once, not theatrically. But materially, that is the first deep shift. The second comes from China, and I want you to understand how important this is because people are still thinking about silver as though it were mostly a monetary curiosity or an old hedge discussed by people who collect coins and distrust central banks. Silver is not only that. Silver is an industrial metal embedded deep inside the future. Solar panels, electronics, electric vehicles, data centers, medical devices, modern electrical systems, fast, conductive, highly efficient technology everywhere. That is the world silver lives in now. And China sits near the center of that world. Chinese refiners handle a huge share of global refined silver exports. That means when China changes the rules around silver exports, the rest of the world does not get the luxury of ignoring it. And China did change the rules. Its older export system was replaced with a tighter licensing regime, which in plain English means silver does not leave as freely as it once did. Again, this is not some screaming headline, it is a quiet rule change, but quiet rule changes are exactly what matter when they alter physical flow. If the country sitting near the center of the refining and export chain makes silver harder to move outward, then every user outside that system has to fight harder for supply. That is basic. Now add to that the fact that Chinese imports of silver surged dramatically. Why? Because demand is real. Chinese retail investors, priced out of other stores of value, turned toward silver industrial. Demand stayed strong. Solar alone consumes an astonishing amount of the world's annual silver supply. That is a fact too few people appreciate. When one sector can eat something like a fifth of annual global silver output, you are no longer dealing with a niche market. You are dealing with a strategic one. And once you combine industrial demand with a tighter export regime and rising interest in physical ownership, the whole structure becomes far more interesting than the old mental model most investors are still using. Then there is COMEX. This is where things become more visible to people who bother to look at the plumbing. COMEX is supposed to represent a major hub where paper silver trading and physical backing meet. Now, I am not interested in melodrama here. I am not going to tell you the vaults are empty and the world ends on Friday. Serious investing does not need that kind of theater, but I do care about pressure. And the pressure is visible. Registered silver inventories have been drawn down meaningfully from higher levels. Some of that silver may still exist elsewhere in eligible form. Yes, I am not blind to that. But the simple truth is that the easier, cleaner, more readily deliverable pool is tighter than it was. That matters because when industrial buyers, investors, and institutions all want the real thing rather than merely the paper representation of the thing, the margin of comfort gets smaller. And it is always the margin that matters first. People love absolutes because absolutes feel cinematic. Running out, not running out, collapse. Everything fine. Reality is almost always more subtle and more important than that. What matters is not whether the very last ounce disappears. What matters is whether the system gets tighter, more stressed, and more prone to violent repricing, because the physical side is no longer as loose as the paper side once implied. That is exactly where I think silver is sitting. Now, let me step back and give you the framework I think matters most, because I do not want you to walk away from this with a pile of disconnected facts. Facts without structure do not help much. I want to reduce this to 3 signals. 3 simple things that tell me whether silver is becoming more attractive relative to the stock market and relative to its own history. The first signal is the silver-SP ratio. This is the compass. If silver is historically cheap relative to the stock market, that improves the asymmetry. It does not guarantee anything on a deadline, but it improves the setup. And right now, by long historical standards, that ratio is deeply depressed. That gets my attention. The second signal is the physical supply. Demand balance year after year. If the world consumes more silver than it produces and recycles, then above ground stockpiles get leaned on. That cannot continue forever. without consequences. Maybe the consequences come slowly, maybe they come violently. But deficits matter, and silver has been running in deficit for years now. That matters, especially when the industrial side is not a cyclical triviality, but a structural demand story tied to electrification, solar build-out, electronics, and all the rest. The third signal is the rule book. This may be the most important one because it is the one the public sees least clearly. Rule changes in finance and in commodity markets often matter more than opinions. Basel III matters, China. Export restrictions matter. The U.S. designation of silver as a critical mineral matters. Each one changes behavior at the margin. Each one raises the strategic importance of real silver compared with paper assumptions about silver. And when the rule book changes under a market that was already cheap relative to history and already tight in physical terms, then the setup becomes extremely interesting. Now, I want to stop and say something sober because sober is how I prefer to invest. Silver is volatile, very volatile. It is more volatile than gold. It is more volatile than a broad stock index. It can move hard and for reasons that do not always appear obvious in the moment. It can punish weak hands brutally. So I am not telling anyone to behave foolishly. I am not saying silver is a bet the farm asset. It is not. A person who cannot tolerate a painful drawdown has no business pretending otherwise. That is not caution. That is honesty. The right way to think about silver is not as some magical all or nothing answer. It is as an asset sitting in a very unusual setup, historically cheap relative to stocks, backed by structural industrial demand, supported by quiet but meaningful rule changes in regulation and export control, and increasingly pressured by the difference between paper market habits and physical market reality. That is the thesis. Not fantasy, not prophecy, not some promise that you wake up rich next week, just structure, and structure is enough for me to pay close attention, because in the end, investors usually do not get hurt because they found the wrong chart or heard the wrong opinion. They get hurt because they never understood the rule book underneath the market they were participating in. That is the part professionals live inside and the public almost never sees. And this silver story, to me, is one of the clearest examples of how a rule change beneath the surface can alter everything above it. So if I had to reduce the whole matter to one plain judgment, it would be this. Silver is not just a sleepy old precious metal anymore. It is an increasingly strategic industrial commodity, sitting in one of the cheapest historical positions relative to the stock market, while the rules governing paper exposure, physical flow, and national importance are all moving in its favor. That does not mean you gamble. It means you stop ignoring it. And if you want a very practical way to think from here, keep watching the three signals. Watch the silver to stock market ratio. Watch the physical supply deficit. Watch the rule book. If those three keep pointing in the same direction, then the market may be setting up for one of those rare phases when something ignored becomes impossible to ignore. And by the time it becomes impossible to ignore, the biggest move is usually no longer at the beginning. It is already underway. That is why I care now, not later, because the quiet rule change is almost always where the real story begins.